Hi, Paul with Stone Barn Portfolios here. You know, every investor needs an edge. Otherwise, they're going to always have just the same return that the aggregate of their holdings can provide, including all of the risk. Um, an edge helps you mitigate risk, mitigate loss of capital, and there are a number of ways to get an edge in trading your portfolio. We're going to talk about one of the ones that we use today. It's an anomaly in the market, meaning that it's something that the market does that you wouldn't expect it to do, given normal behavior of the market. I'm not going to tell you what it is until we connect with my buddy Don, and then we'll talk about it there. So stay with us, and catch you right after this. I know if I don't put a sticky note here on my screen, I'll forget. So, all righty, we are rolling, and all right, it's the end of a quarter, Don, and we're just about a couple hours into the fourth quarter of 2019. Here, it's October 1st, and today, you and I thought it might be a good idea to talk about one of the market anomalies that we like to exploit in our investing, and we've got a little presentation to go through here, and we think it'll illustrate why we think that it's important to have this as part of any prudent investing portfolio. And that anomaly, that is, it's something that happens over and over again. It's observable, it's measurable, it's testable, and you can implement it. Is momentum, and we'll get into a little bit about what that is. I'm going to let you see my screen here, and we'll bring this up and run this from here. And I'm going to give you control the keyboard.
Wow, you put a lot of pressure on me this morning, so early.
Yeah. Oh, you bet. We don't fool around. We make you work for your keep.
Well, I'd say that momentum in and of itself is just a race, and the ones that are the fastest for some predetermined distance are the ones that have the greatest momentum. And while that changes over time, if you have some tools that will allow you to always upgrade your portfolios, and I guess the old, I forgot the great philosopher that first discovered things in motion have a tendency to stay in motion.
That's Isaac Newton's third law of motion. Yeah.
I may have been a little absent that day, but I read it a few times. Anyway, well, let's get started here. One of the first, let's see something. I'm not sure I can. Can you forward this?
I can. Yeah, I think so.
Forward it one thing.
Yeah.
A couple of the premier researchers and early pioneers in the investment business, Fama and French, said the premier anomaly is momentum, and momentum is pervasive. Now, those are some big words that just mean that the premier anomalies, as you said, are things that happen that over and over and over again. So if you use the word pervasive, it occurs in all indexes, all countries. It covers. It's just consistent over long periods of time. We try to exploit that, but we have a few other unique ways to exploit not just momentum. Momentum is what it is, but we'll get into that a little bit. But these are probably two of the more named people, in the industry. So.
Right, and I'll point out too that there's just a ton of academic research and practical research out there for anybody to read on momentum. Probably one of the most noteworthy studies was done back in '93 by two, I don't know if they were professors or economists, but Jagadish and Titman
Yep.
wrote a paper, and they revisited it in 2002 or three, I can't recall which. But a lot of work has been done in this area, and this is, as Fama and French said, the premier anomaly. That is, it acts apart from what you'd expect the market to do, the way that you'd expect the market to behave. This is an anomaly. It's something out of the ordinary, and it's not only pervasive across markets and countries and so forth. It's been persistent over time, and it's something that you can see, you can measure, and you can implement and exploit. So we like things that are backed up by research.
Yes, sir.
All right, let me go to another slide there, huh?
Okay, here's a little busy slide, so just take a second. All the colors, multicolors, are indexes. S&P, OEX, NDX, midcap, Russell 2000, and we have our little blue line is the basket of stocks that are momentum wide.
Mm.
And if there was ever a picture that shows why we like momentum, that's probably it. It is clearly, it's not without challenges, and certainly that's to be expected. Nothing is perfect.
That's right. And I'll point out too that amongst that rainbow of lines there that are grouped at the bottom, that top red line is the NDX, and you can see how that significantly outperforms all the others over time, and that's why we select our stocks from that index.
Absolutely.
Yep.
And one of the there's a highlight there about always fully invested.
Mm.
As a person who has spent a career using tactical measures, and certainly for the right reasons, I think it is something that is extremely beneficial to you to avoid a lot of the bad markets. But the one major negative is that you're really slow getting back into the market.
Mm-hmm.
That's one of the reasons we want to take our Melody, just a little homemade name that we have.
Yep.
It is about a momentum model out of the NASDAQ 100. And I think we may have some. Oh, don't we have a couple of arrows in here that points that we want? Yeah. So we think that stock selection does matter, not just momentum, but
right.
The best of the best momentum. And can you point out right here?
Yeah.
As you go through the 2008, you notice that it started weakening quite significantly ahead of the other indexes, and it was down like anything else. What, 50%, 56, something like that?
Yeah, 54%. Yep.
Yeah, but we left early, and
yeah.
When I say early, I mean like 6 months early.
Yeah,
we were starting to add value, and momentum is just one portion of our portfolio, not just one portion of it.
That's
and
right.
We had other defensive mechanisms that helped us not to go down, but the momentum is clearly one of the more important things that we have. And for using tactical strategies, this is a godsend, because you already have money that's improving your total return way before bottoms in most cases.
That's right. This is the bottom of the financial crisis right here in March of 2009. And the NDX had, that had its bottom right around the same time, and we're selecting stocks from the NDX, and 6 months prior to that bottom, our portfolio was making money, which tells you that there were stocks in the portfolio that actually were profitable, that were growing in value at a time when the whole index was falling. Now, this is our point, the point we made in our last video about over diversification. By owning too many stocks, if you own a representation of that index, you kept going down. But because we pick a few at a time, and we try to own the best ones, we started actually making money in this portfolio again 6 months before the bottom of the market. We also could say that when this portfolio turns over like it did here early, that was a portent of something big that was going to happen, and kind of an early warning. And the same way that this was kind of an early notification that the market wasn't going to go down forever, and that there were stocks that were actually beginning to grow in value. So let's go to this next page here, Don. I think you're going to illustrate something that's real important for us here.
Yeah, as you're fully invested, you end up and have there's some examples in there. Can you move it forward? Yeah, here's an example at the low point right there. Notice that the purple line on top, that's driven by mostly by the momentum component, because they come flying out of those bottoms. I mean, while they're fully invested, your gun is loaded, and the first sound, you're off and running. And there's several examples of this, and that's why it's such an important part of what we do. You'll see some great examples of you're not going to get left at the table very often. In fact, it's the thing that's why we always are going to have money committed for the momentum model at all times.
Right.
It serves a purpose, and
absolutely.
The purpose is it leaves either early or violently.
Yep. And the way that we handle the risk of that is twofold. One, we don't put 100% of our money into that particular basket. And two, in some cases, we'll actually hedge away some of the risk of this downward movement. And while we won't hedge 100%, and to kind of flatten that out, we are able to mitigate some of the risk there. And I should say there's a third way, and that is by pairing it with other strategies that complement it.
Absolutely. Just a little spreadsheet that talks about the momentum model, and it's by years going from 03 up through, I guess, relatively early, August.
Mm-hmm.
And in the, if you can see in there are some mighty large swings, on a monthly basis.
Mm.
But when you go over to the end of the year, I think we had how many? 14 of 16 years.
14 of 17 years. Yeah.
And that's the purpose of it. That is totally the purpose of it. Is that in a normal year, or in a year where you don't have a lot of volatility, you can. I think I'm skinny and have brown hair, and I know that's not true. But we have other things that when you have the tough years like 08 and like last year 18, and probably
right. And like I was just saying, in 08, the loss was severe. In fact, it was down more than this. It was down 53% or 54% at one point during that year.
Right.
But the fact is that we mitigated some of that loss in our overall portfolios by including a hedge for a portion, and also by including another two strategies in there that paired up with this. Really, you get a lot of the push from these kinds of returns. That really adds a lot of alpha to your portfolio if you can manage the risk, which we do with complementary strategies.
Paul, it's fair to say this is not a standalone strategy, because I don't know of anybody that can take some of the swings that are. Look at the first January of 2016. That's a fast way, or 08. You know,
Yeah,
you
yeah.
just personally cannot take that.
Yep. Okay. So next slide here.
This is an old slide. In fact, I've used this for a long time, but it's a little busy. But let's go up and look at the blue line, S&P 500. Got $100,000, and you end up with 443,000 over probably a 16-year period. And compound returns about 9.52. No trades. Maximum drawdown 55%. Blah blah blah. So then I went and said, we're going to run our little momentum model. And we're going to have 30 stocks, 20 stocks, 10 stocks, and 5 stocks. And one of the most valuable things about momentum that most people don't get, and it's also a great advantage for individual investors, is the fact that
either you got a funny ringtone, or you got a mouse dancing on a xylophone over there.
Oh
well.
Is that the fewer stocks that you hold. Look over at the first column, the number of stocks that you own.
Yep.
Look at what the power of what you can do by making some monthly upgrades in your momentum model.
Yep.
That's shocking in a way.
Yeah.
And is it worth it? My answer is probably so. You know, it's probably be a good idea.
Yeah.
And when you pair it with something else to help with the drawdown situation, then you've got a good step forward on of owning some of the more profitable stocks. And then once they go away, they lose their rank. You know, we just have to we find some other ones.
Yep. Yeah. It's really remarkable, and our research has shown us over the years that when you start getting above 15, 16, 17 stocks in a portfolio, that's when you start to see a degradation in performance. You can see we've gone from 5 to 10. Well, there's a 2% per year, 2.5% per year, loss in return. There's slightly less drawdown, but when you go to 20, now you've lost 5% per year. That makes a big difference over time. You're trading more frequently. In this case, you had the same drawdown, but you got paid less for it. When you go to 30, now you're down there almost 7% a year that you're giving up by going to this, and it gets worse and worse and worse. And the problem that we see out there in ETFs and mutual funds is they're holding baskets of anywhere from 75 to 150 and sometimes more stocks. And if they're trying to match an index, they might hold as many as a couple of hundred. And that degradation in performance is due to what we call over diversification, where you're diversified among a bunch of different issues, and what you've diversified away is company risk, but what you've brought into your portfolio is the fact that not everything can outperform everything else. And in our view, it makes sense to own a few that are outperforming all the rest based on their momentum, and it makes a big difference.
One of the cornerstones of how we really believe is that we want to know on a monthly basis what each individual stock does is adding to our portfolio or not. And if it's not, we do something about it. Very simple. But you can't do that if you own 50 or 100 or 200 or 500. You don't know what's going on. We want to know exactly what each stock is doing to benefit our portfolio.
Yep, absolutely. Well, that's the end of that show.
Hey,
yeah,
that wasn't too painful.
No, that wasn't painful at all. I thought it was kind of interesting.
Yeah. Well, I personally have been a momentum player for a long time, but I've never done it as with individual issues as much as I have and working with you on our portfolios here.
Right.
And I think it'll hold the test of time, as Falman French said, because certainly nobody's accused you and I of being academics. So.
No, no, I've been called a lot of things, but academic is not one of them. Yeah, well, that's a good presentation. I hope we taught some folks about our views on momentum and why we think momentum's a good idea. There's a lot of research out there. I can point people to a site. It's actually an investment firm that's not far from me here in Pennsylvania, called Alpha Architect. And now those guys are academics.
Yes.
They're a bunch of really smart people, and they've embraced momentum investing too, in much the same way, that we have. And the thing that they have there that we don't have here is a bunch of academic papers that back up the research that we've done and that they've done. They write it up, and it's impressive. So if you want to know more about momentum, I would suggest visiting Alpha Architect's site. They've got a whole bunch of stuff there. They look at other things too. They look at value. They look at quality. And we do the same thing in that momentum model. Part of what's built into our approach in selecting stocks is not just how fast and how far things are moving, but what kind of quality of momentum is in there. And they're open about how they do that. We're not. We've got a proprietary way of looking at that, and I think it makes a difference. But there's a lot of information out there. But momentum is a key part of our portfolio philosophy, portfolio construction philosophy. Yep. All righty. Well, good to see you. Good to talk to you.
Yes, sir.
And, I'll catch up with you a little bit later, and we'll call it a day. All right.
Have a good one. See you soon.
All right.